Hello, today's question is about consolidation. We will consolidate two companies' financial statements, balance sheets. You will see the alpha and beta balance sheet on the left side. Here is asset and equity and liabilities. Just simply look at that. This is the question here, and there are some information about the question in order to consolidate two companies. Let's be careful that the given date of the financial statements balance sheet is end of September 2018 and acquisition date October 1st, 2011. There are 7 years difference. And Alpha acquired 220 million shares in Beta and gained control on that date. And this is financed by cash payment. The amount is 144 million to former shareholders of Beta on the acquisition date. And also there are another payment, further payment will be paid after 2 years, which is 145.2 million. The amount will be paid after 2 years of the acquisition date. This is important, and 10% is the discount rate to find the net present value of further payment. We will discuss later about this information. And also on the acquisition date, Beta had a retained earning of 80 million. We need to find fair value of identifiable net asset of Beta on the acquisition date to calculate goodwill because there is a payment we call consideration. Also to consideration to have acquire Beta. Also Beta has assets and liabilities, net assets, and payment over net asset is called goodwill, which will go to consolidate financial statements. And here's also property and equipment having a carrying amount of 120 million in Beta, but its fair value is 130 million. Carrying value 120 and 10 million is a fair value adjustment is to made to find correctly fair value of net asset. The estimated remaining useful life of this plant at acquisition date was 2 years. After 2 years, the carrying value would be 0. This fair value adjustment has not been reflected to individual financial statements of Beta. And in the consolidated financial statement, which will be prepared by us, the fair value adjustment, this 10 million difference, is subject to temporary difference for the purpose of the calculating deferred tax. It is subject to tax. There's a potential tax cost expense on this adjustment. The rate of the deferred tax to apply to this 10 million is 20%. This is possibly income tax rate of this country maybe. Also, we need to calculate, measure non-controlling interest. Non-controlling interest will be under equity, and we need to know its fair value on the acquisition date. and fair value of an equity share in beta for each share is 1.7. Maybe it's a public company. No impairment of the goodwill on acquisition of the beta have been evident up to today. Once we calculate the goodwill, there would be no impairment until today, which is end of September 2018. Goodwill is subject to impairment tests every year. If there is some indications, there are some indications to show us there might be a potential impairment, goodwill need to be tested. Okay. First of all, let's calculate the consideration paid by Alpha to acquire beta. Let's say working one here. Change the color of it. Yes, consideration. How much money paid to acquire company beta? Okay. Here is goodwill. We will calculate it. This is the cash payment. Here 100. Let's erase 30. Consideration. Let's say 1. This is the payment after 2 years. This is $145 million. There's a discount factor. This is the formula to calculate net present value. The amount divided by 1 plus 10%, which is the discount rate, power 2, because it's 2 years. Perfect. And net present value of payment is 120 million. Let's say total consideration is that 100. Okay. This is the parent payment, alpha payment. Also, let's calculate the net fair value of net asset of beta. In order to calculate goodwill here, at acquisition, date of acquisition, and also post-acquisition. Difference would be important. Okay, share capital. Retained earnings already given. If we calculate the total equity on acquisition, date of acquisition, it also means fair value of net assets. Difference would be subject to goodwill. If payment greater than payment plus NCI, we will come later. In total, if exceed the fair value of net asset or equity in total. Retained earnings on the date of acquisition is already given, which is 80 million. No OCI. And there's also fair value adjustment of property, plant, equipment. If the carrying amount is 120 million, but fair value 130 million, it means 1 million. Sorry. Also, the question has mentioned that there was a deferred tax, potential tax on this fair value increase with the rate of 20% tax effect. Say, tax expense, deferred tax expense, with 20% of this increase. This is fair value of the equity at acquisition in beta, or fair value of net asset. Let's calculate the parent and NCI share here. Parent, NCI. Of acquired 120 million of 160 million divided by 100, which is 75%, and this is also NCI share. At acquisition, 75% of beta share was acquired by Alpha. This is current. This is NCI share. Okay. The total fair value of net asset is 248. Okay. We need to calculate, by the way, NCI in order to compare the fair value of net asset to calculate goodwill. And NCI is that this is the number of total shares. There was a here share price, I remember that. What was it? Here is, yes, 1.7. It was a public company. Multiply total number of shares multiplied by share price traded in a market. And this is also NCI. Again, one more total here. Here is fair value of net asset. Payment plus NCI over fair value of net asset would be goodwill. Goodwill subject to tested of subject to test of impairment for further years each year, but in the question, they said that no implication of any impairment. Okay. Also, here is no change post-acquisition, and here is the retained earning. Total is here. Also, let's calculate NCI here, working tree. NCI. Fair value of NCI here already given, already we calculate. Post retained earnings. Here is a different 120 million is different between two periods of retained earnings. Today, reporting date and acquisition date, and 25% of this increase would go to NCI. Post-acquisition minus the retained earning at acquisition multiplied by share of NCI. Sorry, not post. Sorry. Increase. Okay. There won't be any effect of fair value adjustment of property, plant, equipment, and tax expense because the useful life of this asset was 2 years in the scenario, but post-acquisition after 7 years. Okay. And NCI would be 96 million. Also, we need a post retained earnings for consolidated financial statements. We need to calculate it. Hey guys, retained earnings here. Okay. Alpha, we are calculating consolidated retained earnings is attributed to alpha. This is retained earning alpha already given. Plus retained earnings share from beta or any adjustment related to alpha need to be added on these figures. For example, This is completely related to retained earnings and maybe OCI. You need to calculate alpha shares. Okay. Let's continue. This is working 4 and working 5. Let's go to alpha investment, exhibit 3 here. On October 1st, 2015, Alpha acquired 36 million shares in Gamma by means of a cash payment of 146 million. And also Gamma total share issued in Gamma was 120 million. Let's calculate the share of Alpha at Gamma. Holding share. It is divided by 30 million. You need to use the equity pickup method because it's an associate. No need to consolidate it. And on October 2015, and this is acquisition date, also end of September 2018, which is reporting date here today. According to individual financial statements of Gamma, show that the retained earnings of respectively retained earnings were 45 million and 65 million. Difference is subject to question because Alpha has a right on the retained earnings after acquiring date, which is 20 million profit. Here Gamma. And Alpha share. Yes. Sorry. This is subject to P&L here. Not profit share. But also we need to calculate something subject to balance sheet. This is associate. We need to calculate associate balance for the balance sheet purpose, per pay balance sheet. And consideration was And also associate here, profit here, associate balance. Here is the consideration of also good data in total. Gamma subsidiary beta total investment in the solo financial statements of Alpha here. $416 million. Here you also see this number. Where is here? Okay. Without this profit, the number is here same. Okay. And let's go to working 6. The leasing exercise. On October 1st, 2018, Alpha began to lease a property under a 10 years lease contract. The annual rate of interest implicit in the lease was 5%. The lease rental payment by Alpha were 10 million for each year for 10 years. The lease does not transfer ownership of the property Alpha at the end of leasing term. It means it's not a financial leasing, it's an operational leasing. Also, Alpha doesn't have an option to purchase the property. It's another indicator that proves this is a operational leasing, not financial leasing. And direct costs incurred by Alpha is 4 million in arranging this leasing. And also the accounting entry made by Alpha in respect of this lease were to charge 14 million, which is 10 million the first installment of the leasing first year, plus 4 million cost of arranging the leasing, recorded under profit and loss statements. And using the discount rate of 5% and discount annuity factor is 7.72. Okay. This is the leasing payment. By the way, there is a wrong booking here made by Alpha. Debit. Debit. Is P&L and cash. Million. Leasing payment here. $10 million. Annuity factor was 7.72. Net present value of all payments. Alpha will pay 10 million for each year, in total 100 million for 10 years. Net present value of $100 million is 77.2 million. Okay, this is the annuity factor to calculate the net present value of all payments. This is also assets, right to use asset. We will calculate this amount as an asset. Also, it would be subject to liability, not because it is net present value of the leasing payments. And this is the recording, this is the accounting treatment should be made rather than this wrong booking. That's the correct booking. Debit. That's asset. Using liabilities, let's say long term or short term, doesn't matter. Liabilities, also debit. Again, credit should be added. Or the cost of arranging leasing, which was, I think, 4 million here. Yeah. Okay. This is end of no opening. Initial recognition or opening. Year end. We need to unwind the liabilities, debit, credit. Let's calculate first of all the depreciation over right to use assets. It was 10 years arrangement. And right to use asset or related allowance account. And total multiply by 10%. Yeah. And also let's unwind the liabilities because the net present value of the leasing payment at the beginning of the arrangement, but year end we need to unwind the net present value to calculate the net present value year end. Was the amount liabilities? It was the rate, which was 5%, need to be used. This interest rate. Now liability balance is 81 million. Okay, and credit of course P&L. Okay, and again debit, credit to the leasing payment deducted from liabilities and cash. And for the balance sheet, right to use asset balance should be 77 plus 4 million minus depreciation. And liabilities 77.3 million plus 3.8 million minus payment. And 7. Okay. We may also calculate the short-term period, but of this liabilities portion, but no need to calculate. Yeah. Okay. Let's prepare balance sheet. But also we need to add some leasing. There is corrective thing. Current. Depreciation. Minus finance costs. Yeah. Also, reversal wrong booking. Again. Yes. Total retain earnings. We did the alpha. Let's prepare the balance sheet here. Consolidated. Alpha group. Okay. Prepare the plant equipment. No investments. Associate. Associating gamma. Goodwill. Right to use assets. Total non-current assets. Inventories, no adjustments made. Simple cash. Sorry. Yes. Equity. Capital. We just add alpha No need to beta equity because it would be subject to non-controlling interest. Retained earning is just distributed to alpha was calculated here. And NCI. Total equity. Here. Long-term borrowing. Plus leasing. So long-term. Deferred tax. And trade and payables. And current liabilities plus current liability. And difference is 0. Thank you for following me and joining. I hope you enjoy with the question. Thank you and see you for another problem.